VC Fluency session number 1, VC incentives and health tech impact. So to set the stage a little bit, venture capital is an industry that is often purposely confusing, using jargon that may at times seem unapproachable, but at the end of the day, it's simple math and use of techniques, tools, and lots of guessing the future with your crystal ball that really matters. So first things first, let's talk about health tech. 2023 was really a bloodbath for digital health. Investment was down, number of deals were down, average deal value were down, public exits are down, startup shutdowns were down, and here are some numbers that you can review. So why was the market doing so poorly when it was doing so greatly before? It has a lot to do with these incentives and these expectations that happen behind the scene. So first up, I think at the fundamentals at VC is where the money comes from. VC funds are run by general partners, so a managing partner, and these are the ones that make the investment decisions. Though where they get their money from are the limited partners. So these can be pension funds, could be sovereign wealth funds, could be hospitals and payers, in particular in the digital health world. And they don't see the day-to-day in terms of investment decisions. At times they're consulted by the general partners before an investment decision is made, not always. But their expectations and anticipations of the future do matter when you think about where you can get money from and how you can deploy capital in the market. So in terms of how a VC fund is structured, for a fund of whatever size, 50 million here, a venture capitalist or the venture capitalist team gets 2% of that annually and 20% of excess returns. So thinking about the 2% annually for a 50 million fund, that is $1 million. That goes to all the fund's operations, right? So that's salaries, could be plane tickets to different conferences, your MS office, rent for a building, technology, tools, etc. So $1 million for a $50 million fund isn't that much money, right? Like a partner would probably want $250,000, if not more. I'm thinking about space. Often VC funds are in like New York, San Francisco, Boston, top geographies. That's not cheap. And this is why like teams tend to be small. Teams do scale with the size of the fund. A $1 billion fund has a lot more assets under management and operating expenses. And this 2% number is an average value. Something you might see often is like you'll get 2% the first 1 to 3 years, and it decreases to 1 to 1.5%, and maybe ends at year 5, even though the fund itself lasts 7 to 13 years. It all depends, but this is a good starting point. So unpacking the 2 and 20. So if here in this example, the fund exited at 200 million, and that's from the initial assets under management of 50 million, that's 4x, that's pretty good return. So when you think of this 200 million number, LPs get their money back, minus administrative fees. So that's 45 million plus that 5 million taken to the administrative fee that's already taken out. You have this 150 million remaining. So 20% of 150 million is 30 million. And that's what the GPs, the fund partners, get back. And then the remaining 120 million goes back to the limited partners. This is what makes venture capital investing attractive. The venture capitalists aren't using their own money. They have the opportunity to make a lot of money if things go well. And also for the LPs, they do capture the majority of the returns if things go well. But that's high risk because if things don't go well, then they may get no money back or just what they invested in and a little bit more. So a few learnings here. The founder and VC incentives are not always aligned. Due to the 7 to 13 year time frame, VCs are incentivized to motivate their companies to build fast versus building smart. Also, exits need to be big, right? Like a exit that only generates an additional few $1 million of excess return that doesn't do much to impact the economics of the total fund. And additionally, you don't need that many exits in a fund, right? Like one fund, if it took 10% of the fund's capital and it return 10, 20x should return the entire fund. And therefore, a founder who thinks of a startup as their little baby, little child, and wants to see their startup succeed, is not always in line with a venture capitalist that rather have as many of their portfolio companies exit as highly as possible, even if it means that a few of them fail along the way. Another important thing to remember is VCs do have a North Star, and that is like returns. At the end of the day, it's a job, and it's their job to make money. It's their job to make their LPs money. It's their job to make LPs happy, so they'll invest in their subsequent funds. So even when you hear venture capitalists say that they're into like equity investing, at the same time, that is sometimes due to marketing, and they really just want to return money. There are exceptions to this. Family offices are a few out there that are truly equitable and out there to improve global human health, et cetera, but it is a rarity. Going back to the health tech impact, like we are seeing some symptoms of optimism in today's market. Tempest, Waystar, BrightSpring all IPO'd early in 2024. AI in particular is a bright spot with 1.1 billion in investment, something that may be the new bubble. Anecdotally, I hear that hiring is going up, and especially for engineering sales, and hopefully we'll see the return of like the strategy role in the future. And this is really due by expectations, right? Like now that we are seeing some returns in the market of these new IPOs, that means that venture capitalists are more willing to deploy company capital to startups. It also means that hopefully LPs are happier and are giving more money to venture capitalists to use to deploy into health tech and other areas. And the final thing I want to talk about is Teladoc, really drilling down the expectations theme. When Teladoc exited in 2020, it was at 4.2x acquisition multiple, 18.5 billion on 1.3 million revenue. As a venture capitalist, something we'll go into later is how when you look to do an exit analysis of a company, you often look to the past in terms of like what other comparable companies have exited at, and in particular in terms of their multiples on revenue. And thus, especially 2020, 2021, everyone was using Teladoc, this 4.2x acquisition multiple, in their exit analysis, which then meant that everyone had high anticipation for future health tech exits in that time frame. And it led to a lot of dumb money being put in this space. And after we saw exits not happening at these multiples, expectations went down. Teladoc's now a 0.7x multiple. And now there's a much less conviction in terms of health tech investment because of the lack of conviction for health tech exits. But as I mentioned in the prior slide, hopefully things change. And we are seeing some evidence of things being a little bit more optimistic now. This is it for VC Session 1. I'll see you next time.